ED and CIO at ICICI Prudential AMC, then joins in on the show right now. Naren, hi, good morning. While it's a welcome change, sometimes you want these flat no-go kind of trading sessions, but I wanted to understand what are you making of the market structure right now, because there's just so many moving parts which continue to impact us. Inflation, dollar index, which way the global market's going to move, whether it's going to be a hard landing or a soft landing, whether the US is going to go into a recession. Having said that, Naren, we've done a lot better than many of our Western or Asian counterparts. But are we still fragile?
Yeah, see, post 2020, we realized that the biggest fund managers are the Fed. They have $8 trillion, and what they do decides what happens to the market. So, when the economy was in very bad shape in 2020, we saw the markets going up because the Fed at that point of time, like Jerome Powell kept saying, we want to create inflation, we want to create inflation. And that resulted in a very bullish market till and now. You know what's happening. Fed and their governors keep saying we want to crush inflation, we want to crush inflation. So we are in a global market where the biggest fund manager in the world, which is the Fed, keeps saying we want to crush inflation. So the markets keep coming down. India has displayed much lower volatility because neither the Indian central bank nor the Indian government indulged in so much excesses. So we are like definitely much lower beta than the global markets. Having said that, I think the real problem that India has faced is only arising out of higher crude prices out of this entire Ukraine issue. Otherwise, India did not indulge in those excesses. So India has been a lower beta market. Still, we have connected capital markets. So till the time the Fed changes its stance and say we don't want to crush inflation, we are going to have volatile markets. And today, because India has handled their macro better, we have a situation where Indian valuations today is one of the highest in the world. And that represents a risk for people who are oriented towards valuations.
Naren, hi, good morning. This is Anisha also joining into the conversation. Very interesting that you are recommending a safe strategy for your clients, which includes SIP, asset allocation, fixed income portfolio, etc. But specifically with respect to asset allocation, how has that changed for you? Because we are hearing more so from the global experts now that cash is no longer trash. That's the word coming in from Ray Dalio. Jeffries has increased their cash allocation by 3 percentage point. How has your ideal asset allocation changed?
See, in fact, 3 to 6 months back, we did a lot of brainstorming within our company and realized that the only product which is geared for increasing interest rates was the floating interest category. And actually, we did a lot of effort in that area to recommend investors to invest in that category because it's the only category which gains out of increasing interest rates. And it was very clear that we are going to have increasing interest rates, not just in the world, but also in India on a continuing basis. So actually, we actually recommended this category to everyone we could think about because it's the only category in debt where increasing interest rates is a big benefit. And we continue to think that within asset allocation and within that in debt, floating interest becomes one of the biggest categories to benefit when interest rates will go up. And there is no sign at this point of time that interest rates won't keep going up. So it becomes one of the most, cash, of course, is attractive. But then if you have a benefit, you will get benefit out of increasing and increasing interest rates everywhere in the world. So you choose that category. And that is what we have made. We've been trying to tell investors to look at that category. Surprisingly, in the first 3 months of recommending the category did not do well. And so people thought, how can it be that it didn't do well? But then that has changed. And I think that is one of the, at ICICI Prudential, we think that it is one of the most interesting categories as long as interest rates are headed upward, which seems to be the case at this point of time. Broadly, if you look at it, debt, particularly on the shorter duration side, is another category within asset allocation, which people have not looked at for a long period of time because interest rates had come too low after COVID. And I think it becomes something which people have to look at for investing. Globally, it is cash, but in India, even short duration leads to lead interest rates, whether it is ultra short, whether it is dynamic bond like all seasons or short term. Any of these kind of categories also lead to a very interesting investing experience because India is not a zero interest country and has never been a zero interest country. So these kind of areas turn out to be very interesting for investors. And in India, somehow, we have become an equity country where people think that only equity leads to returns. And over the last, thanks to the Fed, we have never had setbacks in equity. So we have a situation where people not only think equity is the only asset class, people think equity doesn't deliver negative returns. So, we have spent quite some time trying to first tell people 10 years back that categories like balanced advantage should be considered. Now we tell people that not only should you consider categories like balanced advantage or asset allocation, you should also consider debt. Because I think it's very important that investors carry a good experience about the mutual fund industry. And for that, you need to invest in debt mutual funds and in asset allocation categories for them to have a good experience of the mutual fund industry.
Yeah, that's a very relevant point. But I don't blame investors also because from the start of COVID to now, things have just so reversed in terms of what the future for debt and equity is looking like. So sometimes I guess everyone's puzzled out there. But I want to talk about your new NFO as well. Tell us a little bit more about it.
So, as a framework, what we try to do is we look at themes which have underperformed. And in 2018-19, it used to be commodities and pharma. So in recent times, we found that housing, PSUs, and auto had underperformed. So, we said that there is a good scope for transportation and logistics, and these are all base needs. Housing is a base need. PSUs had underperformed for a decade despite profits being high. We felt that how long can two-wheeler industry give grow from have a negative growth of minus 25%, and car industry has hardly grown for a decade almost. And we felt that logistics as a sector has to keep growing in a country like India because we can't afford to be very small and export and import. So we felt that we always look for themes which have not done well over a long period of time, and we approached the regulator to give us permission to launch thematic funds like the Transportation and Logistics Fund. And we felt that such an opportunity for long-term investment, after all, India will have to have much more two-wheelers on the road, much more cars on the road, much more commercial vehicles on the road over a period of time. And India has a beautiful manufacturing base for auto ancillary. Again, logistics has to keep improving because frankly, over a period of time, both India, everyone talks about China plus one and now Europe plus one. Both China plus one and Europe plus one means that logistics have to grow over the next decade or the next few decades. So we were looking for such a theme, and we approached the regulator to give us permission to launch such a scheme. So we feel that this is an interesting theme to invest in for a long period of time. And in the near term, we have market volatility. So we have the combination of being able to invest into that market volatility and a long-term theme which looks interesting. And that's why we've launched the ICICI Prudential Transportation and Logistics. It's coming at a time when we think market volatility is not going to be low. And that's something investors have to think about. And that is good because if you are doing it when market is going to be non-volatile, it's much better to invest in an existing scheme because the existing scheme gets invested on day zero, whereas here it takes time to build a portfolio and invest. So we think that this is coming at a time when market volatility will be pretty high over the next 3 months due to what the Fed is doing, what ECB is doing, what BOJ is doing, etc.
Naren, okay, that's the view coming in on the NFO, but let's also talk about the largest allocation, which is in ICICI Pru Life AMC. Financials, of course, make that list. Walk us through, the outlook that you see in terms of overall credit growth picking up and how you're looking at, particularly in light of the fact that we have earnings as well coming up, what exactly it is that you're working with?
See, if you go back 10 years back and today, the credit growth was good 10 years back. But at that point of time, you had a huge non-performing loan issue. Today, if you go fast forward, now you have high credit growth and no non-performing loan issue. You have a very pristine balance sheet for most of the top banks in the country. So you have high credit growth. You have no virtually very low NPLs. You have margins which will expand because the credit to deposit ratio is zooming. If you look at the data which has come out yesterday, the incremental credit to deposit ratio is zooming at this point of time, which will help the banks. So we are in a very interesting period for banks at this point of time. I must say that the borrowers are going to be not in the best of shape because interest rates are going to continue to go up, which is the reason floating rate kind of products are good for investment. But if you are borrowed on the floating rate side, interest rates are going to keep going up. And today, most of the bank loans are floating rate. So actually, it is the banks which are going to benefit at the expense of the borrowers over the next 2 to 3 years, which is why we think that within the financial services space, banking is in a very good position, particularly the banks with a very good CASA franchise, and that has been our framework which we have had over the last 2 years, and that is one of the reasons why we have a reasonable weightage in that sector at this point of time.
As a value investor, I remember you were quite positive when it comes to the likes of power stocks earlier. I see that one of the recent sell includes names like NTPC. What has changed? And the addition seems to be on the side of Sun Pharma Alchem Lab. Are you now seeing value when it comes to the pharma sector then?
No. See, when we look at the defensive sectors of the economy, one of the themes that we have at this point of time is recession-free exporters. And, there is a budding possibility of a recession in the Western world. So we said that, and what's rupee today and how the rupee is moving. So we said we have to bet on recession-free exporters. That's the reason why we have been positive on pharma as a sector, because that's a recession-free sector. People have to consume medicines, and that will be the last thing that they can economize on. So that's the reason why we are positive on pharma. So if you look at the power sector, our weightages have been much higher than the benchmark in almost all the funds in ICICI Prudential. So some amount of our position we would still be one of the largest investors in the power sector, and some amount of profit booking is always necessary for us as investors to look after the profit booking for the investors. And we are believers that periodically we have to book profits in many of the stocks that we invest in, and that is one of the principles of investing that we have learned over a period of time, because markets are always volatile, and if you never book any profits, sometimes it becomes a problem, and that's something we have learned over a period of time. And some of the sectors where we have large positions in, we always tend to book small amounts of profits because it helps us to actually reduce the average cost of our holdings in some of those stocks as well.
Naren, I'm tempted to ask whether you are also tempted to reduce exposure to IT.
If you look at IT, it's a sector where at some point of time we have to look at increasing our holdings in some of the funds where we are underweight. As the US recession develops, I believe that we will have to look at increasing our holdings at that point of time. It is a sector with huge long-term potential, and it's a sector which also benefits out of a depreciating rupee. But in the near term, it's hurt by the global outlook for growth. But the long-term outlook looks very good. So it's a sector actually we should be betting into rather than cutting our holdings at this point of time. And I don't think it's a sector where, of course, if it suddenly does well due to rupee moves, we could cut our holdings. But as such, we would be looking to invest in that sector. And that's the way we would be looking into the entire sector as such.
Okay, that's the view coming in. And where do you stand when it comes to the entire consumer discretionary space in light of what we're seeing as well with the inflationary concerns as well? What's your outlook?
See, you've seen some of the quarterly updates which have come, with a value hat that I have. In my team, I find it much more difficult to buy because many of the valuations are not cheap at all. Many of the growth members in the team actually point out, like some of the quarterly updates have clearly shown that this is one of the sectors which is doing extremely well at this point of time. So I believe that, it's tough for a value-oriented fund manager in our team. It's good for a growth-oriented fund manager in my team. So I believe that the team is doing extremely well. And I believe that currently the consumer discretionary area is one of the few pockets which are doing extremely well and may do very well in the festive season. But it is meant for the growth-oriented investor, but the value-oriented investor will balk at the valuations that is given to the sector at this point of time. So that's how we are positioned. So the growth-oriented investors in the team really like the sector at this point of time.
It's in the Okay, so that's the word coming in as far as the IT sector is concerned. But Naren, what about the consumption space? Now, and there's a dichotomy there, right? The discretionary part of it in terms of the malls, in terms of the sales that you're seeing from the likes of Trend, Shopper Stop, etc., are quite solid. While on the other hand, there is Dabur talking about margin pressure. There is GCPL, which did not report great set of numbers. How should we really look at this entire space?
The valuations of the staple names have never been cheap over the last 5 years. Hopefully, we'll get an entry point with these kind of lower growth numbers that we're seeing. And maybe we will get that opportunity over the course of the next 6 months or 9 months. But if you look at the moats of many of these companies, they're pretty strong. So I believe that the opportunity may come in the near term, but clearly at this point of time, the discretionary space is doing extremely well. The staple space is doing extremely badly on a relative basis. But if we take the next 5 year outlook, I think the staple space has good scope. But it's a sector which never derates. So we keep looking for opportunities for derating, but it never happens. And that's where the challenge comes for investors like us. If you look at most of the other sectors, take for example auto. Auto, there are a lot of take two-wheeler industry. It's also a basic necessity. It's a sector which has done pretty badly, but it's a sector which has derated significantly in the last 5 years. So, you get very interesting opportunities, for example, in two-wheeler industry on the transportation side. But consumer staples has rarely derated actually. So I would say that that's the challenge that we have. But that's where the opportunity lies that, suddenly we've seen at different points of time, you get a good opportunity to actually pick up. This year, for example, there have been some quality banks which got derated. So like that, different years, you'll get different opportunities. And that is the interesting aspect of active management, which we can use in this year. Like who would have expected in the last 1 year that US stocks will underperform India so significantly. So like that, that's the beauty of active management and which we can use over the next few years. And next few years will also continue to be volatile till this entire global inflation comes under control and the Fed says everything is normal. So I think we'll get such opportunities, in my opinion.
Yeah, absolutely. Naren, great to have you on the show and always good speaking with you.
Thank you.
Thank you.